We are looking live at Aditxt, ticker ADTX, and the price is currently 11 cents, down about 14.29% in the first hour of trading today, October 29th. Now, the immediate expectation when you see that, or when you see its 52-week high of $177.50, is a story of a catastrophic event. The belief is that this was once a high-flying $177 biotech that crashed, and that now, at 11 cents, it must be an incredible bargain, a coiled spring ready to rocket back up. But the reality is that the $177.50 price is a ghost. It's an illusion, an artifact of multiple aggressive reverse stock splits that were executed to keep the stock from being delisted. This isn't a fallen angel. This is a company that has been systematically destroying its own share structure to stay on life support. And today's 14% drop is just a continuation of the market's complete lack of confidence in its business model. The disconnect isn't between $177.11. The disconnect is between the company's scientific claims and its financial execution. The common ground for speculators, especially on online forums, is that a stock this low, with a market cap this small, can be easily manipulated or squeezed. The hope is that it can't go any lower, and that the 52-week low of 9 cents is the absolute floor. They see a tiny market cap, which we've seen reported as low as $600,000, and think a small amount of buying pressure could send it soaring. They see news, like the announcement 2 days ago about its subsidiary Pearsanta starting human trials for an endometriosis diagnostic, and they expect that to be the catalyst. They see a stock that dropped over 32% just yesterday, and they think a dead cat bounce is inevitable. But this thinking is a trap. The reality is that a floor of 9 cents is not a sign of support, it's a warning of proximity to $0. A stock with a market cap under $1 million isn't a hidden gem. It's a company that the market has, for all intents and purposes, declared to be worth almost nothing. Its value is less than a single high-end apartment in New York. The challenge for investors is to stop looking at the price and start looking at the balance sheet. The company is in a desperate race against time, burning through cash it doesn't have, and its primary business operation for the past year has appeared to be, unfortunately, dilution and corporate actions to maintain its NASDAQ listing. Let's look at the recent movement, because it's brutal. We had that 32% collapse yesterday, and now we're following it up with another 14% drop today. The volume is high relative to its tiny float, but it's all selling pressure. This isn't accumulation, this is capitulation, and in some cases traders just playing with pennies, trying to scalp a fraction of a cent. The microeconomic environment for speculative, pre-revenue biotech is the worst it's been in a decade. Interest rates are high, funding has dried up, and investors are not interested in ideas. They are interested in revenue and profits. Aditxt, in its most recent filings, reported quarterly revenue of just a few $1,000 against a net loss in the millions. This is the definition of a cash burn machine without a fuel source. So what does Aditxt even claim to do? The company has a few platforms. Its main ones are Aditxt Score, which is supposed to be a diagnostic technology to monitor and understand an individual's immune system, and AdImmune, a therapeutic platform intended to retrain the immune system to deal with things like autoimmunity or allergies. Then there is the Pearsanta subsidiary, focused on early cancer detection. And that brings us to the news from 2 days ago, the start of a human study for a blood-based endometriosis diagnostic. In a normal market, for a healthy company, this would be significant news. It's a real-world event, a step forward in its scientific program. But for ADTX, the market's reaction was a shrug, followed by 2 days of massive selling. Why? Because the market doesn't believe the company will be solvent long enough to see these trials to completion. The market sees this positive news as a potential tool for management to justify another round of toxic financing or dilution to fund the trials. This brings us to the short selling situation. When you see a chart like this, you know shorts are involved. But it's not in the way you might think. There isn't a major public short seller campaign with a 100-page report. The short thesis here is simple and doesn't need a report. The company is running out of cash and has a history of reverse splits. Short sellers are betting not against the science of endometriosis. They are betting on the math of the balance sheet. They're betting on the company will either be delisted from the NASDAQ for failing to meet the $1 minimum bid price, or that it will be forced to conduct another reverse split. Let's talk about that because it's the most important actionable insight for anyone looking at this stock. A reverse stock split is when a company forcibly combines its shares. For example, in a 1-to-100 reverse split, if you owned 1,000 shares at 11 cents, you would suddenly own 10 shares and the price would be adjusted to $11. This is how ADTX got that 177 high. It wasn't real value, it was financial engineering. Companies do this to get their stock price back over $1 to avoid being kicked off the NASDAQ. But it doesn't add any value. And what almost always happens next, as soon as the price is back up, the company immediately issues and sells millions of new shares, dilution, to raise the cash it needs, which starts the downward spiral all over again, crushing the new higher price. The shorts are betting on exactly this cycle repeating. How can you track this? You look for SEC filings from the company, specifically proposals for a reverse stock split. You also watch the institutional ownership. Looking at the filings for ADTX, the ownership is almost non-existent. We're talking about 17 or so institutions in total, holding a tiny 54,000 shares. And the largest holders are firms like Virtue Financial and HRT Financial. These are not long-term investors. These are high-frequency traders and market makers who are in and out of the stock in milliseconds. The real long-term smart money funds, the Vanguards, the BlackRocks, are nowhere to be found. Morgan Stanley and UBS, according to recent filings, dumped their positions, cutting them by over 99%. The institutions have left the building. Here's a question for everyone watching. What's your take on the recent Persanta endometriosis trial news? Do you see it as a genuine positive catalyst, or do you agree with the market that it's just noise in the face of the company's financial problems? The retail sentiment on this stock, as you can imagine, is a war zone. On one side, you have deeply frustrated investors who got caught in the previous reverse splits and have seen their positions wiped out by 99% or more. They are angry, vocal, and often warning new traders to stay away. On the other hand, you have a fresh group of speculators who are only looking at the 11-cent price. They see the low float, they see the high volatility, and they are discussing a potential short squeeze. They believe that if they can all coordinate, they can force the price up. But the reality of this setup is that the shorts are not over-leveraged and trapped. They are simply waiting for the inevitable, delisting, or another reverse split. They are holding a winning hand. So what is the future outlook? It's a very binary and bleak path. The expectation, the hope, is that the Persanta trial yields miraculous results immediately, that the company signs a massive partnership with a major pharmaceutical giant, and that cash flows in. This is the lottery ticket scenario. The reality is a countdown clock. The company is not in compliance with NASDAQ's $1 minimum bid price. It will receive a delisting notice. Its only tool to fight this is another reverse split. That is the most likely next major catalyst for this stock, and it is a deeply negative one for shareholders. The other risk is that they can't even raise the financing needed for payroll and basic operations, and the company files for bankruptcy, sending the stock to zero. The opportunity, if you can even call it that, is an acquisition. A larger company might see some value in the Persanta intellectual property and buy the entire company, but at a sub-$1 million market cap, they could offer a 200% premium, and shareholders would still be getting pennies on the dollar compared to where this stock was on a split-adjusted basis just 1 year ago. I'm curious, for those who trade in this microcap space, I want you to comment below. What is the single biggest red flag for you when you see a stock like ADTX? Is it the reverse splits, the cash burn, or the lack of institutional ownership? In closing, Aditxt is the ultimate expectation versus reality stock. The expectation is that you are buying a cheap biotech at 11 cents that used to be worth $177. The reality is that you are buying a company with a market cap of less than $1 million with virtually no revenue, that is burning millions, and whose $177 price